cost accounting and strategic cost management. Our topic for week 5 is cost volume profit analysis. Our product costs consist of direct materials, direct labor, and manufacturing overhead. Under manufacturing overhead, we have variable overhead and fixed manufacturing overhead. The variable cost consists of direct materials, direct labor, and variable overhead. And for the fixed cost, our fixed manufacturing overhead. This is our cost volume profit graph. This is the 40,000 is our fixed cost. The red one is our variable cost, and the black one is our sales. Okay, so this is the area for our variable cost, and this is the area for our fixed cost. So this is the point wherein sales and variable cost meet, and we call this the break-even point. And the break-even point is in units is 5,000 units, and in peso it's 100,000 pesos. So it means that if you sell 5,000 units, there is no gain nor loss. So balik lang yung investment mo. But if you sell less than 5,000 units, which is under this area, then you will suffer a loss. But if you sell more than 5,000 units, this is the higher area, area above your break-even point, now you will have a profit. So cost volume profit analysis is a method for analyzing the relationship among cost, volume, and profits. A critical factor is setting selling prices, determining product mix, and maximizing use of production facilities. It is also used to calculate the level of sales necessary to achieve a target profit. So let's have one case. The Jormark Textile Industries. The company has two products, product A and product B. So the company sold 20,000 units at 10 pesos per units. For product A, we have 200,000 peso sales, and for product B, 200,000 pesos. For the variable cost for product A, 7 times 20,000 units will give you 140,000 and a contribution margin of 60,000 pesos. The fixed cost is 45,000 and the net profit is 15,000. The same with product B. Okay, your variable cost is 4 pesos per unit times 20,000 and you will get 80,000 variable cost with a contribution margin of 120,000 less fixed cost of 96,000 and will give you an earnings before income tax and of 24,000 pesos. So let's compute now for the break-even point. So we get the selling price per unit per product A is 10, variable cost is 7, and the contribution margin per unit is 3 pesos. The fixed expenses is 45 pesos. Okay, the same with product B. We have a contribution margin of 6 pesos and a fixed cost of 96,000. For the contribution margin ratio, for product A, it's 30%, and for product B, 60%. Okay, now we compute for the break-even point in units. For product A, fixed cost over your contribution margin per unit will give you a break-even sale of 15,000 units. With product B, na fixed cost of 96,000 divided by your contribution margin per unit of 6 pesos will give you a break-even point in units of 16,000 units. For the break-even point in pesos, the formula is fixed cost over your contribution margin ratio. So 45,000 pesos for their fixed cost, divide by your contribution margin ratio of 30% will give you a break-even sales in pesos of 150,000. The same with product B, with a fixed cost of 96,000 pesos, divide by your contribution margin of 60% will give you a break-even sales in pesos of 160,000. Now, if you want to have a desired profit, let's say in this case, the company wanted to have a desired profit of 30,000 pesos. So what is the formula? So your fixed cost plus your desired profit of 30,000 pesos divide by your contribution margin of 3 pesos per unit and you will get 25,000 units. For process B, your fixed cost of 96,000 plus your desired profit of 30,000 divide by your contribution margin per unit of 6 pesos and you will get 21,000 units. Now, for the break-even point in pesos, so your fixed cost plus desired profit divide by your contribution margin ratio will give you a break-even sales of 250,000 pesos. The same with process B, your fixed cost plus desired profit divide by your contribution margin ratio will give you a sale of 210,000 pesos. So let's check. If you, in our break-even point in units, we have 25,000 units, right? Then you multiply by the selling price of 10 pesos and you will get 250,000 pesos. The same with product B. You have your 21,000 break-even sales in units. You multiply by the selling price per unit, so you will get 210,000 pesos. Now we go to margin of safety. What is margin of safety? The margin of safety will determine how far the company is operating from its break-even point. Gaano karami bago siya makarating sa break-even point. Then you will suffer a loss pag below break-even point. This is the amount that sales can drop before reaching the break-even point. It measures the amount of cushion against losses. So if you will go down below your margin of safety, it indicates that if you will go lower pa, you will have a loss or you will incur a loss. So how to compute for your margin of safety? Again, the problem is Jomark original break-even point was 15,000 tablets and 18 tablets for process B. The company expects to sell 28,000 tablets. So our margin of safety formula is expected sales minus your break-even sales. So for process A, if the company expects to sell 28,000 tablets minus your 15,000 tablets for product A, and you will get 13,000 tablets as your margin of safety. The same with process B, 28,000 tablets minus your 18,000 tablets break-even point, and you will get 10,000 tablets. Now, how to compute for your margin of safety in pesos? So, 13,000 tablets times 50,000 tablet, 50 pesos per tablet, and you will get 650,000. Okay, for process B, our margin of safety in units is 10,000 tablets times 50 pesos per tablet and will give you 500,000 margin of safety in pesos. Now we compute now for the margin of safety ratio. So 13,000 tablets divide by your 28,000 tablets will give you 46.43%. Okay, your margins of safety tablets na 10,000 units in process B divide by 28,000 tablets will give you a margin of safety ratio of 35.71%. Now we compute for the operating leverage. Okay. High operating leverage will result to low variable cost, high fixed cost, high contribution margin, high break-even point, and sales after break-even have greater impact on profits. Ibig sabihin yan, pag ang sale natin is 100, ang variable cost is, let's say, 40, you will have a high contribution margin, right? So let's go to low operating leverage, which means your variable cost is high, your fixed cost is low, you will have a low contribution margin and low break-even point, and sales after break-even have lesser impact on profits. So let's say our sales is 100, our variable cost is 70. So yung contribution margin mo lang is 30. So mababa na yung contribution margin if your variable cost is high. Okay. Now we compute for the degree of operating leverage. It measures how a percentage change in sales will affect profits. So the formula for degree of operating leverage is contribution margin divided by your profit before taxes. So when margin of safety is small, the degree of operating leverage is large. So what is the formula? Margin of safety is equal to 1 divided by degree of operating leverage. Tignan nyo yung difference. Pag margin of safety, your denominator is degree of operating leverage. While if degree of operating leverage is 1 divided by your margin of safety percentage. So let's have one example. Okay. In this case, our actual sales is 200,000 units. The break-even sales is 90,000 units. The contribution margin is 408,000 pesos, and profit before tax is 224,400. So margin of safety percentage is equal to actual sales minus break-even sales divided by your actual sales. So in this case, let's apply the figures. 200,000 minus 90,000 divided by your actual sales of 200,000, and your margin of safety percentage is 55%. Now, we compute now for the degree of operating leverage. So contribution margin of 408,000 divided by your profit before tax of 224,400 will give you a degree of operating leverage of 1.818. So we use the formula, okay? The one I gave you, how to compute for the margin of safety. So margin of safety is equal to 1 divided by degree of operating leverage. So 1, you divide by the margin of safety of 1.818 will give you 55%. Under degree of operating leverage, 1 divided by your margin of safety of 0.55 will give you a degree of operating leverage of 1.818. 8. That's all, and thank you.